Morning, everybody, and welcome to the second in this series of IMAP webinars. The focus for this week's webinar series has been on high net worth clients and the way in which different types of advice organisation serve those clients. My name's Toby Potter. I'm known to many of you, and I know many of you, and thank you very much for joining today. Firstly, I should say, in particular, thank you to Kyle Lidbury from Perpetual Private, who stepped in at short notice in place of Martin Crabb. Martin injured his back last night and is bedbound, and said to me when he rang with apologies this morning that his commitment to the industry was high, but not so high as to include presenting a webinar from his bed. So Kyle has generously stepped in to talk about the Perpetual Private approach to investment management. And that's going to be the theme of today's session. We're going to be talking about the investment management considerations in serving a high net worth client base. On Monday, Andrew Tracy and Will from JB Weir and Will Howard from Fitzpatrick's talked about more of the client service issues, finding clients, serving them their needs. Today, we're going to take more of a focus on the investment management considerations. It's part of study which IMAP has done on the high net worth market, and it's being developed in a number of ways. So this week's webinar series, which is CPD accredited and which we'll have available through our YouTube channel. We're producing a white paper based on the interviews and questionnaires which we've undertaken with a number of organisations, including all 4 who've participated in this week's webinar series and about another 10 or 12 organisations. And that paper is really on serving the high net worth market and the role that managed accounts might play in that service offer. And then as part of our Advice in Action conference in July, we'll be presenting a masterclass on this topic. We'll have joining us in that masterclass presenters from Findex, JB Weir, Shaw & Partners, Climb, Fitzpatrick's and Jana to talk about different aspects of serving a high net worth client base. So some of the topics we'll be considering in that masterclass will be restructuring to address the high net worth market, serving family offices, a critical part of many advice organisations often. Are there high net worth, are there client investing needs different? Similar, that'll be a topic we'll be talking about today. And managing the compromise between high service and high efficiency in that market. Next week, we'll be running a webinar really for the mid-year. So it's an opportunity for us to involve 6 managers to talk about where markets stand today, what the last 6 months have delivered for us, and their expectations of markets and positioning in those markets are looking forward. So on Monday, equities with InSync and SG Hiscock dealing with international and domestic. Wednesday is Western Asset Management and Russell talking about fixed income markets. And then on Friday, physical assets and infrastructure with Mary Power from Jana, their head of property, and Shane Hurst from Clearbridge, talking about those 2 asset classes. Back to live events, and aren't we glad that we are now all able to go back to live events? Advice in Action in Melbourne, Sydney, and Brisbane is an opportunity. The theme of that is sustainable business models for advice. We've changed the format of Advice in Action so that it runs from breakfast to lunchtime. Starts off with a breakfast, concludes with a lunch. nearly as much in terms of CPD and content in that period from 8 till 1:30 as in a full day, but it gives advisors an opportunity to go back to the office in the afternoon. We think that there's so much going on now that the opportunity to attend, listen, take part in the sessions, but still have an afternoon to work is a better format. That's accompanied, for those who want to stay, by the masterclass. And then in September, our opportunity to showcase our portfolio managers and their thinking about the way in which they're developing managed accounts. So I needn't add this, but of course you all know that how to ask a question, and I'd encourage you to ask those questions. We had some excellent questions on Monday about this market. So let me introduce our presenters. Alexandra Ventelon is the Executive Director and Head of Research Wealth Management for Morgan Stanley. Morgan Stanley is an award winner over several years in the IMAP Managed Account Awards. And Alexandra is the head of the team that builds the portfolios for for Morgan Stanley. And Kyle Lidbury is the head of investment research for Perpetual Private. Kyle leads the 20-person investment research team within Perpetual Private, responsible for this area. So thank you both, and Kyle in particular, thank you for stepping in at short notice to take us through your approach to investment management, in particular in the way it plays out in the high net worth market. Both Morgan Stanley and Perpetual Private have high net worth clients. And so we've got a fascinating opportunity to talk to two very different organizations about their approach to portfolio management. So I'm now going to ask Alex to lead off with a short discussion on Morgan Stanley's approach to investment management. And then I'll ask Kyle, and then we'll go into a discussion session. And as I say, I'd encourage you all to send your questions in. Thanks very much, Alex.
All right, thanks, Toby, and thanks everyone for joining us today. It's a very interesting conversation today around high net worth individuals and how we manage their investments in wealth management in Australia. Certainly, to give a bit of context, it is a primary target and segment for Morgan Stanley wealth management here in Australia. Just to give you a bit of an idea, in our proprietary platform, which we call PWM, Private Wealth Management at Morgan Stanley, 97% of accounts exceed $1 million AUM, and 88% exceed $2.5 million, and 45% exceed $10 million. So high net worth clients is really at the core of what we do in Australia, with 106 advisors across the country able to service wholesale clients. From my vantage point, which is really research and investment management, I am managing a team here of 5 people. We cover the main asset class, as well as fixed income and ETF selection. We are a relatively smaller team compared to some of the other leading wealth managers here in Australia, because we are lucky to be supported by 2 major networks in terms of research. One being Morgan Stanley Institutional Research, which supports us with more than 700 analysts, strategists, and economists worldwide, to whom we have direct access. And on the other side of the spectrum, we also have access to the 150 analysts supporting Morgan Stanley Wealth Management in the US, which is a $5 trillion AUM business. So they have developed a number of really best practices around client portfolio management, and in particular high net worth and ultra high net worth money management. So leveraging all these insights, really what we're trying to do in Australia is make the most out of it, import the processes and the views that we think make the most sense from an Australian standpoint, and also account for the specificities of the Australian investor in terms of taxation, as well as, you know, the exposure here to the domestic market. Clearly, high net worth individuals are in general more sophisticated investors, and we like to support them with a sophisticated multi-asset portfolio management after having designed with them their investment profile. Some would be very happy with an off-the-shelf core multi-asset solution. Some would largely prefer a customized solution, which is something that we offer above a certain threshold. Very often, though, they will want to have a satellite exposure, and this satellite exposure can be sometimes also the lion's share, but to complement this multi-asset portfolio via more opportunistic investments, very often in the field of alternative investments, which is you know, an area where we are able to really leverage the Morgan Stanley scale in terms of bringing prime products to Australia, whether they're coming out of the US or coming out of Asia. And we have a product team here doing a fantastic job on the field. We can also leverage the due diligence for offshore products done by our US wealth management out of the US. That's really a strong support here. We can also provide to these clients structured products, access to prime IB deals, as well as opportunities to invest directly into equities, whether it's in Australia or whether it's in international equities or fixed income as well, or whether that's wrapped into a managed fund or under an SMA format. So as you can see, we have quite a comprehensive offering and really structured around these core satellite approach. So that's, in a nutshell, our definition of high net worth investing and how we go about it. And I'm happy to go into further detail after Carl's presentation.
Thanks very much, Alex. And there was a question that came through earlier on, which I'll come to later on in the sort of discussion area. So now it's my pleasure to hand over to Kyle Ledbury to talk about Perpetual Private's approach to investment management for this market. Kyle, thanks.
Thanks very much, Toby. And I think it's actually, despite sort of coming in on as a relatively last minute ring in, it's good, I guess, to contrast our approach with Alexandra's, just from a perspective of Perpetual and our, I guess, our local domicile. Perpetual is at its heart and heritage a trustee and a fiduciary business, right back to the 1800s. We were set up by wealthy merchants who, you know, as part of their business had to go overseas for extended months and months at a time, and they wanted to set up a business to take care of their assets whilst they were away. And so that's how Perpetual was born, as a trustee business. And today, our wealth management business, which includes that original trustee business across you know, normal trust estates and philanthropic vehicles, also includes a very substantial wealth and advisory business. So as a dealer group, we're about 18.5 billion in funds under advice. And we've been running managed accounts for our investors since 2014. And that crosses, you know, both traditional asset classes and alternatives. We do it a little differently to you know, other parts of the market, in that we leverage our multi-manager funds in order to get access to managers that may not have a domestic presence or a local domiciled fund. And what that means is that our asset classes, from a portfolio perspective, are fairly uniform across our client base, particularly, you know, using managed accounts. And that's how we've achieved scale there, and we can actually leverage the, you know, scale for the benefit of the client. I think one of the sort of myths is high net worths, just because they do have complex needs, but that doesn't necessarily translate into, really different portfolios from client to client. So managed accounts are absolutely a really good tool to scale your best ideas across a broad client base. You can bring the cost benefits of being able to negotiate rebates or have access to, institutional unit classes in order to get fee savings for clients. And then we can then use that fee budget in more interesting things, like Alexandra was saying. So we manage a program of alternatives of about 1.2 billion going over. We divide our program into growth alternatives and income generating alternatives, which generally are private credit in nature. And our growth program covers things like unlisted infrastructure, unlisted property, private equity, hedge funds, and we're investing as an institutional investor in those units. So that alternatives program provides the core of our alternatives exposure, as does our implemented portfolio program across traditional asset classes. And then, quite rightly, you can actually tailor out a portfolio through provision and access to satellite exposures. One of the great things about running an alternatives program is that you can then provide access to clients on an individual basis that may feel inclined or want to increase exposure to a particular fund or a particular investment within the program. And there are always funds that won't necessarily suit our program, but may suit our high net worth investors, such as certain impact investments, which lack the scale to be included in a larger alternatives program, as well as the sort of smaller venture capital funds, particularly in the Australian market. I think one of the big differences that we bring for our clients is that we are Australian investors, and we're highly aware that our clients are Australian. So everything and all of the due diligence that we do, the operational due diligence, the tax review, the legal reviews, and the structural reviews are done from an Australian investor perspective. And so we're providing that ability for our clients. When we're investing, we've had to vet all of those various structures and investments from the perspective of an Australian investor, and we can make sure that there's no unforeseen circumstance, there's no exposure to penalty withdrawal tax rates in foreign jurisdictions or certain asset classes that may quarantine profits within that local domicile because of and US real estates can be a pretty tricky asset class to access from that perspective. But so that's generally our approach around high net worth investing. We do leverage managed accounts, and your best ideas in Aussie equities aren't going to be different to your best ideas in for different clients. And I think that's really important. You're going to build a portfolio of high conviction managers, which will be fairly uniform across most of your clients. It's really around their needs, which can be complex, the structuring of their affairs, and then also access to more interesting deals, wholesale deals that may require a larger minimum investment, which does tend to make it more appropriate for high net worth clients. Thanks, Toby.
Thank you very much, Kyle, and Alex, if you'd like to join us as well. Let's start off by talking about the issue of how much is managed internally versus how much what and how do you outsource investment management. So which parts of the investment management process live in-house? Which parts do you look to external managers to provide?
I'm happy to start on that one. So we have a few different approach here. When it comes to multi-asset portfolio management, as you would all know, my team provides this service under the SMA umbrella with the collaboration of our investment solution team. The Morgan Stanley multi-asset portfolios are invested through sort of fund-of-fund approach. And using external managers, we have a preference for external managers, very much like Kyle. We have a series of model portfolios, but we do like the ability, especially for high net worth individual on our appropriately platform, to invest into managers that are domiciled overseas, especially when it comes to international. equities. We do also provide the option for clients to manage their multi-asset portfolios, with their financial advisor, where my team is providing guidance around, recommended TAA, tactical asset allocation, versus SAA, and where my team has a bit more of a consulting approach. We do that also very much in the high net worth space, and with also not-for-profits, where they have their own investment charity, operating committee, whether it's a board or investment committee, and they will want to make the decisions themselves, and are very happy to have us as a bit of a consultant on the asset allocation as well as the fund selection decision. So that's the way we operate. And same with regards to what we call the satellite type investments. We usually, especially for alternatives, rely on a best product approach. So we very much product agnostic. It all comes down to doing the work on the due diligence side and making sure this is the best product. That translates into having a very, very, very large majority of external products in the multi-asset portfolios that we manage in-house. We have 0 Morgan Stanley branded products. In the more opportunistic buckets, if we find, if the investment solutions team who's in charge of that finds that there's a very good Morgan Stanley option, then we will bring it to our clients. But we really want to emphasize this open architecture, where we really looking for the best funds and the best investment opportunities. So we are quite agnostic in terms of product. We're quite agnostic as well on what sort of model the advisors and their clients want to use, whether they want to delegate the management onto us or they just want to take the advice from us. We do service both very happily, noting that clearly for the advisors that and their clients that use our service in terms of multi-asset portfolio management, then it creates a lot more time for us in terms of client relationship management and having those conversations with the clients, rather than being doing rebalancings and looking at trade execution, etc.
And Kyle, how much of what you do is an in-house capability, and how much
So my team includes, we have our own direct equities team that runs our direct equities managed account. And so that's a fairly substantial part of our clients' assets.
Separate from perpetual asset management.
And it is quite separate from our asset management business. It is a managed account offering. There is no equivalent fund, and it is run for our clients. So it has all of those features that you'd want for a direct equities portfolio being run as a managed account. So low turnover, high transparency, communications and understanding of when trades occur and why they're occurring. So we're producing all of that documentation and distributing that. And that's about it's well over $4 billion in terms of our clients' assets are in that direct equities offering. It's by far and away most of our clients take out the Aussie equities exposure in that form. And then in terms of our multi-manager team, they run all of the capital markets assumption, asset allocation for our portfolios across various risk profiles, special purpose profiles for charitable clients, focusing on maximising an after-tax return for a tax-exempt investor, etc. And also manager research is done in-house. We do have access to consultants, and that crosses traditional and alternative assets. We do have some perpetual managed funds. In general, as a sort of rule of thumb, about 20% might be in-house managed across things like Aussie credit, Aussie equities. We had selected, for example, Barrow Hanley as a manager a few years before Perpetual ended up acquiring that business. So we
liked it so much we bought the business.
But it also, it was part of the discussion, I guess, if finding quality managers offshore, right? So I think we try to balance that. We are part of a quality asset management business, and we don't want to just exclude just for the sake of excluding, but we are very conscious around conflicts. We're very conscious around Chinese walls, in terms of direct equities and the other asset management asset managers that we employ. Our investment committee has 2 independent members on it. Generally speaking, if we're recommending in-house products, the other management or employees of Perpetual will abstain from that vote, and the independents will be providing that oversight and governance function. And those minutes are there, to be reviewed. So we do take the conflict seriously. We manage it appropriately, but we have no pressure on the team to use in-house products. We are very much focused, like Alexandra is saying, very much focused on best of breed capability and finding the best managers to build portfolios for clients.
So can we just go back a step to the way in which you build portfolios? Do you take a risk profile based approach or an absolute return approach? Do you have a set of do each of you have a set of standard portfolios that are your sort of starting points for portfolio construction?
Yeah, I mean, I can start with that. We take a traditional risk profile approach, and then we're applying asset allocation calls at different levels, so because we're running those multi-manager funds via mandates for asset classes, we can actually make more active and dynamic tilts there because the cost of implementation is a lot lower and our ability to execute is a lot quicker, right? So we might make calls within those funds that we wouldn't necessarily make that call if it meant, redeeming and applying out of different funds within an international equities model portfolio, for example, where the cost of that implementation is quite high. So that's sort of an example of where we'll be making those calls and those decisions for clients within that sort of asset allocation framework. But we do, as I said, we do run sort of specialist AAs for charitable, where we've got capital restricted trusts, private charitable trusts and otherwise, which can't distribute capital. So we can afford to take more illiquidity, for example. But in general, we'll be running portfolios with an eye on Australian super regulations and requirements where, you do have that 20% limit on illiquids. And so we will generally, on average, our client base would have about 15% in those sort of private asset and unlisted markets.
What about you, Alex? How does Morgan Stanley approach its portfolio construction process?
Yeah, not too dissimilar to Cal. I think we have a very sequenced approach to investing in terms of starting with the SAA, strategic asset allocation, which is made for the main 5 risk profiles that we have. How we go about it is really that we start with doing the capital market assumptions, risk and return forecasting for all the main asset class. We have a team in the US that does that for international markets. Once they've done theirs, we always catch up with them, see what the underlying assumptions are behind their expectations. And then we catch up with our local Australian macro team here to see what the objectives, not the objectives, but the forecasts are for the trends in terms of key macro variables in Australia for the next 7 years. It's our cycle for capital market assumptions. Once we've done that, then we create our set of capital market assumptions for Australian markets, blend that together, optimize our strategic asset allocations with the goal of hitting our risk and return objectives that we have set for each risk profile. And we come up with these SAAs. These SAAs are usually refreshed every 3rd year with a check-in every 1 year in case the markets move too much and we need to do an out-of-cycle refresh. So we define those SAA target in ranges that most clients will be happy to take. And then we'll do, of course, TAA overlay here based on how markets are moving and how our views are moving as well. Again, very similar to Cal, we do also have a number of clients, probably higher up in the AUM spectrum, lots of not-for-profit or even ultra high net worth and family office that will require a custom asset allocation where they've done the work themselves in terms of defining their required rate of return and their required risk budget. And we will really work with them in terms of defining an appropriate asset allocation and manage to this custom SAA and TAA budget.
I want to talk about that issue of customization. I want to think about it in two contexts. One is sort of how much money is required, and this was one of the questions through from the audience. How much money is required, to warrant being treated as a custom client, firstly, and secondly, the intersection between your internal sort of standardized process and what you allow an advisor or expect an advisor to do in terms of customizing the portfolio approach with each individual client.
Look, we sort of, or how I position what my team does is we construct investment solutions for a broad client base. So we're trying to build portfolios that can be used, across the business, but then it's up to our advisors and our partners to talk to clients and translate those solutions into a bespoke, portfolio to the extent that it's got to meet, what the client needs, right? So I don't think that you can just, if you're sort of just designing one solution for everything, you're sort of in industry fund land or super land, it's not going to account for the specific needs of a member, which is really why we, an advice process is so valuable, particularly, for the high net worth end. In terms of, alternatives, that is where, scale is important, because some of these alternatives will have much higher minimum investments. Now, the core of our alts program is our fund of funds, and so we're able to, scale and pool our clients' investments into a fund of fund. They have other advantages in that, you can effectively provide, an entry and an exit point for people entering and moving out of portfolios with, monthly applications, quarterly redemptions on those programs. So we do run an amount of liquidity within the programs in order to facilitate that. Sometimes we can negotiate a lower minimum investment. Obviously the platform will pull together, and individual investors in order to meet the sort of scale required by the manager. If you're using a feeder fund or you've actually built a feeder fund to access, you do need scale to make that fund feasible, and the cost benefit's got to work out. There's a cost in building a structure. You've got to have enough money in the structure to make that worthwhile. Otherwise, so we do pay a lot of attention around fees and scale, and that's sort of where you do need to have a certain level of scale in order to access some of those opportunities.
And so would you allow, or do either of you allow advisor discretion at all in serving your clients, or is it once it gets to an advisor, it's all on recommendation and acceptance with each client?
I'd like to briefly talk to that. I mean, we acknowledge that what we're doing is we're providing a sort of core set of best ideas, but there will always be individual circumstance that may require something else, either whether it's legacy, they're on a different platform, or they're on, they're not able to access certain parts of our offer. And we can't justify changing platforms, which is getting more scrutiny nowadays. So there will always be advisor discretion. We have a process where advisors can effectively fill in the gaps that my team would normally provide for the advisor. So if they view that there's a product out there that's not on an approved product list that is necessary for the client, they can follow that process, justify the need, source a research, source research to justify the product, and it's got a suitable rating, etc. And then the advisor takes over that process. So absolutely, our advisors can tailor if client need requires it, and we still have good governance and a good robust decision-making process for that to occur.
In terms of how we operate at Morgan Stanley, clearly we have defined a threshold of 50 million for a custom SMA managed by the research team and investment solution here in Australia. So that's your sort of full hands-off delegated portfolio management service. But we have again sort of like 2-3 layers of operating model. That's the sort of full hands-off solution for larger clients. Then we have the option, I think, relating to Carl was saying around, FA discretion. We do allow, of course, FAs to run client portfolios where we will really intervene here in terms of providing the asset allocation advice in terms of SAA and TAA, and FAs will have to operate within the bandwidth of the defined SAA, and we will have the risk team performing the controls on that. My team as well provide what we call the focus list in terms of a preferred managed fund that the advisors can use, but we also do provide an approved list as a business of funds that are approved for use within Morgan Stanley, whether they are domestic domiciled fund or offshore fund. We have this approved list that the advisors and their client can pick from, as well as we are open to a sort of a new ideas in case we have funds that would sort of fill a gap as well in our offering, where the domestic team in terms of investment solutions could be performing a due diligence in bringing that to our approved list. We are aware that some clients, again, especially in the NFP space, want to be a bit more hands-on and wouldn't be necessarily satisfied with the sort of SMA approach, like to work with their advisors. And again, that's where my team and the broader Morgan Stanley network and research acts as a consultant in terms of trying to help them build a portfolio that suits their objective, but
I think we've just lost Alex here temporarily. So I was going to lead on to talk about deal flow.
Advisors.
We just lost you there a bit, Alex.
All right, is it better now?
Yeah. No, that's good. Because
Yeah.
I was going to lead on to talk about deal flow and the type of client you were talking about there that wants a bit more hands-on or wants a bit more, perhaps expects a bit more from a a global broker. The extent to which how you manage deal flow for clients or IPOs or new investment opportunities, the way that fits into the process.
Yep. Of course, maybe I'll get started on that one, assuming my connection is better. Yes, well, we have a product team here under the investment solution umbrella that's doing a fantastic job at bringing those deals, whether they are Australian products. I'm talking deal flows. There's IPOs, of course, here in Australia. There's global capital market opportunities as well that we are bringing to the local clients. And we also are quite active in terms of bringing allocation into funds that are harder to access. That's probably one of the specificities of Morgan Stanley, is really to open investments into these global funds that are usually close to the general public. And where I'd say probably our approach is a bit different from Gal, is that we don't necessarily run a fund of fund or alternatives program at Morgan Stanley. What we're trying is to really leverage the scale, get access to these global opportunities. And because we know that the flows are sort of guaranteed into these prime funds by our wealth management businesses for the good opportunities, of course, out of Asia and the US, we get an allocation for our Australian client, and we will really try and work on lowering the minimum investment required to access these programs. So that's more of our approach. And really, that's the advisor job at Morgan Stanley also, to come forward in terms of client segmentation and bring those opportunities to the clients to whom they think it's the most relevant.
What about Perpetual, Kyle? Does deal flow end up through your fund of funds products or going directly to clients?
Oh, look, I mean, we don't tend to offer IPOs or things. It's not really our space. We don't have that sort of brokerage market participant type status. So for us, it is around. I think what our clients expect of us is, if if we find something interesting in market, we can at least provide a lens or a filter or some sort of quality review around what that offer is and provide assurances from that respect. Where we do get sort of higher interest is when we've done the DD and we like it for our program, and then we can also offer, that to individual investors at the same time, But yeah, it's not something we do a lot of. Obviously, within our funds, and the managers are doing, IPOs and participating in the institutional market. And, one of the things under, with TMDs and other sort of increasing regulation, IPOs are becoming more and more difficult to offer to retail clients. So they are becoming much more a wholesale space. I mean, hybrids are pretty much wholesale only nowadays. So it's one of the things from a retail perspective, we're not doing much of that, but we are participating because, within the funds, the fund managers are able to access that market.
Yeah. There are a couple of other issues which I want to touch on. One is illiquid investments and the we've spoken about alternatives, but the way in which you think about illiquidity in client portfolios, either generally through your risk profiles or specifically for clients. How do you approach illiquidity for this market?
So for us, I mean, we're obviously, as you gathered, we are big advocates for finding, opportunities in unlisted and private markets. And I think it's becoming even more important that as an advisor, as a wealth manager, you need to be participating in these areas because they are growing. The private equity space is growing. The number of listed companies on exchanges is declining. There's more and more participation in these parts of the market, and part of and how we view illiquidity is it is something you're giving up, and you need to be getting something for giving that up, right? So if you're giving up liquidity, you need to have a high level of confidence that the manager can exploit that illiquidity through a higher use of manager skill to generate higher alpha, or an ability to take advantage of special situations. Because illiquid and unlisted markets are less efficient, skilled managers should have a greater ability to exercise that skill. And what you do find is that in unlisted and private markets, manager outperformance is persistent and it is highly dispersed. So your best managers outperform significantly compared to the universe, much more than in listed markets. And those best managers tend to keep outperforming, so they don't go through cycles. So those first quartile managers tend to stay the same. So access is really important. And being able to identify those fund managers that can do that, and monitoring those fund managers are really important, because if a certain principal leaves, or the founder's gone, or someone else leaves to start up a new boutique, you need to understand where the skill base was and whether or not it's gone, or whether or not the team is sufficiently resourced to keep carrying on what they've been doing previously. Because you're investing with these managers over really long periods of time. Private equity funds tend to be 10 years plus one. So you need to have a really high degree of confidence. And then the other side is, if you do make a mistake or you haven't chosen the right manager, it's really hard to fix. So you're stuck, and so doing that DD, you do need to do a lot of DD and cover all your bases before you're making these investments. And it is not a well-known market. I think most people would be able to name traditional fund managers and, your T. Rowe's and Franklin Templetons, etc. But when it comes to alternatives, the really significant managers, we know a few of them down here, like Blackstone, KKR, but it is generally a very different universe of managers in that space.
What about Morgan Stanley, Alex, for its approach to illiquidity?
Yes, so it's a very interesting debate. I would concur with Carl. I mean, our research shows the same thing in terms of alternatives, both hedge funds and private markets being the asset class where you have the most dispersion between the good and the bad managers. So clearly, due diligence is everything. So that's why we have this sort of a two-step due diligence. The due diligence being done overseas for offshore product first, and then doing another round here in Australia, making sure that it complies with with everything we can expect from those investments. So in terms of managing the illiquidity from a client standpoint, I'd say there's two things here that are worth mentioning. The first one is that in our multi-asset core management program, we are sticking with relatively liquid products, because clients might go in and out of these products, and we consider they are the core solution. So we want to keep it relatively liquid. We have a decent share allocated to alternatives, including private markets in our model portfolios, but we try to stick with what we call liquid and semi-liquid products, meaning that we can redeem within 3 months. That's for the sort of core program. On the satellite things we do, of course, here have a lot more flexibility, and our investment solutions team will bring a whole variety of options with different type of lockup periods. And really the work that we're doing on the one hand is on the due diligence side with regards to these products with lockup periods, but also, and very importantly, education. And I would say it's twofold. It's client education, and it's also advisor education, making sure that clients and their advisors, basically everyone understands the trade-off between liquidity and returns, understanding the underlying asset class, understanding that these funds could be seeing some markdowns in the short run. These funds might be deploying capital at a different period than what was expected at the beginning. These funds could be gated for a while as well. So a number of things can happen, but if you partner with the right manager, certainly you're gonna really lower the uncertainty around all these events that can happen throughout the life of the fund.
Somebody in the study we did are doing in the high net worth space, somebody made the comment to me that even these clients are okay about illiquidity until they're dealing with their soon-to-be ex-wife's lawyer, at which point illiquidity becomes.
We can't deny that comment that Alexandra made around gating is really important. I think you need to be explaining the risks to the client, right? And the fact that, okay, so there is liquidity when it's there, and there's no liquidity when it's not, and I think gating funds has traditionally been the end, of a fund's life. As soon as it's had to gate, that's it. It's a verifiable disaster, and the fund is basically in wind up. Whereas you can't deny the fact that these are liquid exposures, right? And so you can manage liquidity to an extent. Some of these funds can give you liquidity from time to time. You just need to be on top of those events and being able to manage the liquidity in your portfolio. But you do have to position these as basically liquid exposures. The reference to the divorce lawyer, but it is really important. I think as alternative managers get better at giving access to wholesale clients, high net worth clients, to these types of assets, we still can't deny that an individual is different to an institution and has different needs. And so, I feel like it is about managing expectations with your client and making sure that they understand what they are investing in. I know it can be cold comfort 5 years from now when they sort of forget that conversation, but you do have to sort of really preface that and talk about what's happening before clients invest into these structures.
One of the questions that's come through from the audience is about whether you only deal with wholesale clients, and this sort of to extend that a little. You both talked early on in this about the complexity of clients' affairs. They tend to have trusts, family trusts, mixed up families, company investment structures, and so on and so forth. So firstly, do you only deal with wholesale clients, and how do you manage that sort of complexity of structure, across a client group?
Yeah, we are still committed to retail advice, absolutely. And we also, as a default, when clients, individual clients come into the firm, they are treated as retail clients. Unless for whatever reason, whether it's a portfolio requirement or individual circumstance or desire, they want to be treated as wholesale. When it comes to, say, smaller institutions and not-for-profits and charities, we will default into a wholesale setting there. However, with individuals. And, I think one of the big questions is, the requirement for an individual to be wholesale versus a super trustee is different. And so if we were wholesale only, it would make it quite difficult to deal with the superannuation side of a lot of our client base, right? So no, in essence, no, we still provide retail advice. We still maintain, all of the file notes and protections and things required to deliver that.
What about Morgan Stanley, Alex?
Not too dissimilar from Perpetual. We have, the vast majority of our clients would also service retail clients, basically because we think that there's an area around intergenerational wealth transfer and broader family relationship that will necessitate this ability to service retail clients. We have a handful of advisors that are only servicing high net worth individual under the wholesale license, but that's really a minority of operators within Morgan Stanley. So we would like to have this ability again to deal with broader family relationship.
Yeah, and in fact, that came out pretty strongly across all the groups that we spoke to in undertaking this study, that there are very few who go, right, we only do wholesale. And in order to do that, you've got to set a lower bound for client relationships up in the sort of $5 to $10 million range. And there are some organizations who can do that, but that's rarefied atmosphere. All right, look, well, as we wrap up, is there anything which you would like to bring up that we haven't had a chance to cover or that we haven't spoken about?
There's just that one question on discretionary at Perpetual. So I sort of talked about the 18.5 billion under advice. In terms of discretionary assets, about 8.5 billion of that. So yes, we still maintain an advisory offer. We still have all the frameworks and model portfolios and APLs in order to do that. But yeah, discretionary is a very big part of what we do.
Yeah, and what about you, Alex? How important is discretionary portfolio management in the Morgan Stanley?
What I can tell you is that it's at the core of what we do, but unfortunately, Morgan Stanley doesn't want to communicate on the figure itself.
Yeah, sure. Okay, well, look, then let's wrap up by talking about your expectations, the way your portfolios are positioned right now. Are you overweight or underweight Australian exposure relative to your SAA targets? Over or underweight global equities? I asked that question because yesterday I saw one multinational come out with a position that the 10-year outlook for US equities is their lowest that I've ever seen, and you may have seen that. And I saw a consultant come out with US equities as their preferred international equity exposure. So
I'm happy to get started on that. We had this similar debate with our US peers when they refreshed their capital market assumption earlier this year, and we were looking at the results and the assumptions behind that. And very interestingly, what they found is that the outlook for US equities is around 4.5–5% for the cycle ahead in their calculation, and that's really courtesy of the very high starting valuations. Whereas bonds,
real or nominal?
That's nominal. That's nominal. And the interesting fact coming out of their work was that they had very similar return expectation for corporate bonds in US and global markets, between 4.5% and 5%. So their view was that net the risk return trade-off was massively skewed towards corporate bonds over equities, and certainly that was also more positive for risk taking into alternatives and unlisted markets as opposed to private markets. As opposed to listed equities. Now, that's the US market. This US market has been doing a bit of a thing of its own since the beginning of the year. The other markets on average are a lot more investable for the long run, given, starting valuations drive most of the outcome over a long horizon. Just in terms of TAA, how we position, we still, notoriously quite conservative. For international market, it's really a matter of the US being very stretched right now, but we are seeing opportunities in stock markets where the cycle is turning for us. It's mostly emerging Asia or Asian markets as well as Japan. In terms of Australia, from an equity standpoint, we had been a bit more constructive because the Australian economy had been more resilient, but clearly the latest batch of data and response from the central bank makes us fear that the battle against inflation is lagged and far from being won. There is more upside risk on Australian rates as there is on US rates, and that could potentially put a lead on the index appreciation in Australia for equities as well as for bonds. So we're a lot more mixed about Australian capacity to outperform for the next 12 months. And as a result, we're more looking at emerging opportunities again in offshore markets ex-US.
Yeah, and to take that further, I think, the Aussie central bank has been a bit of a laggard. If we're, given where our rates are versus offshore. So yeah, definitely some upside risk in Aussie rates. But to sort of, I guess, a counter argument to that is there's a lot less upside in rates than there used to be. And so the risk of going into bonds and seeing more hits from a duration perspective is less. And we would say that there's probably, good value in bonds and more upside risk than downside, I think is a good way to put it. The combination of where rates are, can they go too much higher? And you are now getting a cushion from yield, because rates are increasing. So you are getting a return out of your bonds from a coupon perspective. Look, equities are still going to be a really important part of your portfolio in terms of inflation hedging, and equities have proven pretty resilient in being able to pass on those price increases to consumers at the moment. So I find it interesting the talk around green inflation and then surprised at what corporates are doing, which is to maintain their margins if they can. It's capitalism, right? So they will do that to the point where demand starts to come off, and demand is still pretty strong, unemployment's still pretty low. Sort of more broadly speaking, we would look at real assets, and you need to be more selective in terms of the real assets that you're in. If you're in real estate, are you in your prime funds, prime buildings and assets that are doing well, as opposed to further down the spectrum where they are really facing into some headwinds. In infrastructure, are your infrastructure assets GDP related? Are you in airports that will have good times when GDP increases, or are you in sort of more those regulated assets where they can increase prices in line with CPI and maybe more defensive in a higher inflation? So I think it's just being a bit more granular, which all points towards we've always favoured active management, but I think active management, and you've seen this in the institutional level, active management's getting more attention nowadays. So is your portfolio 100% passive? And do you think, which has been a winning strategy over the last decade, do you think a bit more active management of your portfolios is warranted? And we would sort of suggest that's the case. Talked about the ability to implement active management through an alternative framework where we find, in hedge funds, et cetera, these are highly active, highly less correlated strategies compared to traditional assets. So we'd be still favouring those assets in that environment. But that's sort of where we're looking, remaining invested, because, I don't think many people would have predicted the last quarter. But also being aware that what you're seeing nominally is now pretty different to what you're experiencing in terms of real returns. In high inflationary environments, the average outcome is negative real returns at a portfolio level, right? And it's hidden because the nominal numbers are still positive. So it is really important. You need to be much more focused on your clients generating that real return to maintain the real value of their corpus and the real income generating capability of their portfolios.
Great. Well, look, Alex, Kyle, thank you very much for your time today. I've really enjoyed our conversation, and I hope that those of you who are in the audience have found it worthwhile too. So let me just remind you of a couple of things that we have coming up. So let me just find this here. So next week, we'll expand on this issue of the position and the outlook for markets, fixed interest, equities, fixed interest, and then as Kyle was just talking about, physical assets and infrastructure. And I know from the briefing sessions that we've had with Jana, in particular, there are some very interesting things to say about property in that session. The masterclass as part of our Advice in Action conference may well be of interest to you if this webinar series has been of interest to you. And I'd encourage you to all think about attending the Independent Thought conferences in September, where there's an opportunity to engage directly with portfolio managers. There'll be about 30 portfolio managers involved in those Independent Thought conferences. So thank you very much for joining us today, and we'll look forward to talking to you next week. Thanks, guys.
Thanks, Toby.
Thanks, Toby. Thanks, everyone.